podcast. It is the final day of April, April 30th, and Brent crude oil is trading down over 1%. It's at 63.50 on this infamous day. The first 100 days of Trump 2.0 finally comes to a close today. And over that period, since Trump took office, the day he took office, Brent was about $80 a barrel. Now it's 63. It's a kind of a 20% drop. Let's kick off this morning with Jamie Ingram, senior editor of the Middle East Economic Survey. Jamie, an easy question for you. Will oil prices be higher, lower, or much the same after the second 100 days of Donald Trump?
Thanks for kicking it off with an easy one there, Sean. Yeah, I mean, to be honest, I was going to bang on to the second 100 days of Donald Trump, but you got there ahead of me. I think that is going to be what is going to be the driving factor in oil prices and commodity prices more broadly, quite frankly, in a lot of the equity markets, is what are the policies going to be that come out of the White House on the next 100 days. Are we going to see more reversals on tariffs? Are we going to see these famous trade deals that apparently have been where world leaders have been beating the path to the White House, and apparently all these trade deals are in the offing? I don't know. I think that such trade deals are very complicated beasts to finalize, and when you're talking about deals of that number, I'd be very surprised if we see anything on that scale being finalized or even provisionally agreed on in the next 100 days. I suspect that oil prices will probably be drifting a little bit lower. Certainly no big surge to the upside, but when markets are being driven so much by hard to predict policy decrees coming out of one particular location, all bets are off, really.
What about, Jamie, just to follow up on that, because of course another big event of this 100 days is OPEC Plus decision to accelerate its output increases. How much of that has played a role in this sort of precipitous drop in oil prices over the last 3 months? And where do they go next?
I'd say that the OPEC decisions have probably amplified some of the price movements, but they've not been the core driver. And let's take the IMF, for instance. They had their WEO, their Global Economic Outlook, released last week. They attributed the main declines to demand side dynamics. That's a position that I would agree with. We will, of course, be seeing the 8 voluntary cutters from the OPEC Plus organization meeting next Monday. I think it is the 5th of May, to decide on what their policies will be for June. There are indeed discussions within that group about another potential acceleration. That is something that was floated at the last meeting, is my understanding. So it's not come out of the blue, but that's very much led by concerns over non-compliance of some of the producers there, rather than by some of the more macro level supply-demand issues.
Victor Yang, senior analyst at JLC Network Technology. Victor, there's so much to talk about from China. Great to have you on. Let's just start at the basics here. Of course, there's all of this stuff in the world that's impacting everybody, and including China. But let's just look at the Chinese oil demand, oil imports over the last few months. I mean, if you just arrived from Pluto or Mars, you might say, oh my God, China is very healthy and loves oil. You're on mute, Victor.
Yes, sorry.
There we go.
Yes, well. And when we look at oil demand, there's no significant direct impact yet, or say in the short term. But over the long term, the impact would be more significant because of the, impact on export. When export shrink, demand for energy can be affected eventually. For now, the biggest problem, the biggest hit on China is the export, as China is still a big market for Chinese export. As we know, China has been actually diversifying its export, but the exports to the United States still took over 13% in the first quarter, close to 14%. And a lot of factories, say in the Pearl River Delta, where I'm in Guangzhou, Zhuhai, and these cities nearby, they export a lot to the USA. And there's been some research on such factories, and some factories depend on the United States for 70 to 80% of the export. So these factories will be affected most significantly. For now, the orders from the United States have been basically stopped, halted. The US buyers has said, let's stop it for the moment and wait and see how it goes on. Well, so the difficulty is that finding alternative markets for these factories. And
In that surge we saw of U.S. buyers getting a lot of stock in before the tariffs came into effect in
Yeah.
April. So there was a surge of exports from China to America.
Yes.
And at the
Yes.
same token, there seemed to be a surge of oil imports into China. What was all the oil surge into China for? Was that for consumption or for storage?
Well, partly for storage, because the country's crude runs in March was not high. There was a lot of maintenance from late March and April, particularly April and May. So the run rate at refineries are not high at the moment. And in March, independent refineries boosted their purchase not in March, before March, for February, they boosted delivery for March because of concerns about tightening supply when the United States increase its sanctions on a lot of vessels, cargoes. So they actually purchase more than they consume in March. And say in Shandong, for instance, yes, a lot of cargoes arrive in March.
Let's welcome Rahul Kapoor, Vice President, Head of Shipping, Analytics and Research at S&P Global Commodity Insights. Rahul, obviously shipping has been so many ways been at the front of this 100 days and impacted in many ways. Of course, the sanctions, the tariffs, the idea of more oil supply from OPEC plus countries. What can we see in the shipping pricing at this moment that tells us about where we're going to go next with the context of obviously we had the surge, as we just talked about, in and out of China in recent months ahead of the tariffs, but really, where are we going next?
Yeah.
What do shipping rates tell us about where we're going next?
Sure, Sean. So I'll start with the container shipping or the merchandise trade,
Please.
right? I think that's important because that's the one which is most impacted by what's happened over the last few weeks, right, in terms of tariffs. So if you look at over the last several years, right, shipping has been suffering from this COVID-19. We had Russia-Ukraine war, Panama Canal, Suez Canal. All of these things led to a chaos in shipping markets, right? Primarily delays, port congestions, and so on. And that has helped shipping markets over the last few years, right? I think what is happening now is essentially you will still have some inefficiencies which will get built into the system. But what we are worried about is the demand side. I would point you towards WTO's recent downgrade of a global trade forecast, right? At the start of the year, the expectation was somewhere in the range of 2.5 to 3%, and they've downgraded that for this year to just flat 0.2, right? The global economy is not being downgraded to that level, but your world trade is being downgraded to multiples of what we are seeing in terms of the downgrade, right? So that's signaling to you what is likely to happen with the global trade. So in the short term, what happens is because of these inefficiencies which are being built in, carriers are still able to keep some of those rates supported. But as the demand starts to fall off a cliff, and I'm not saying that falls off a cliff longer term, I think in the very medium term, right? So you would have heard about the bookings out of China are down, right? 20-30% in terms of after the tariffs came about. May is looking pretty weak into the US imports. So we saw a lot of front loading. That cargo is being discharged now. So it hasn't started flowing into the data. But if
And
looking at
just
the
let
forward,
me ask a
yeah.
question on
Yeah,
that, if you
sure.
would. The traffic from China to the West Coast America, which is the
Yes.
biggest, the most lucrative trading route into Los
Yeah.
Angeles, i.e. on the container side, are there less ships making that journey or the same amount of ships with less cargo on each ship? How does it usually impact?
Certainly. So there's something called blank sailings which happen in container shipping, right? So what that means is the same number of ships, but you avoid ports as well as you don't carry that much cargo. So we are seeing that plus actively pulling out of shipping capacity as well. It's happening on both fronts, right? So lower volumes. In certain cases, we're hearing about volumes are down in certain cases over 40 to 50% from China, right? And in terms of blank sailings, they are as good as down around 20 to 30%. In certain cases, the number of blank sailings are reaching the levels which we saw in terms of COVID, right? You haven't started seeing in the data from the US side, but you're certainly seeing it that from the Chinese side, right? But another interesting fact which is happening is what we call the non-origin China cargoes, right? Or sorry, non-China origin cargoes. So we're seeing massive surge. So movement from Southeast Asia. I think you're talking about ASEAN, you're talking Vietnam, Cambodia, Laos. All of these are seeing utilizations increase. So what's happening is US is still asking for those products as such, but because of the tariffs, you're not getting that from China. You're trying to get that out from other parts of ASEAN or North Asia for that matter. That's what we're seeing on that particular front on merchandise trade at the moment.
Jamie, just picking up on your interview this week with the OPEC Secretary General, I wanted to get some of the highlights there because it was kind of drilling into what seemed like a fairly technical issue, but nonetheless a critical one in terms of data-driven forecasting for demand and supply. So, Jamie, could you just give us your own headlines, take away from that interview? What was it telling you? What should we sort of walk away from it?
Yeah, thanks, Sean. Thanks for flagging that up. As you say, very much on the getting into the weeds on some of the technical issues. There has been an increasing divergence in the near-term and long-term forecasts of major providers such as OPEC, the IEA, EIA, these kind of guys when it comes to what's going to happen with global oil demand. There's an element that some of it, there's accusations being thrown around of politicization of the data, that people are trying to look at what their favorite outcome is and then read back as to a pathway to get there rather than just looking at what the emerging trends are. So those are kind of the broad brushstrokes of what was looked at in the interview itself. OPEC is, given the nature of OPEC, safeguarding the interests of the major oil producers for the group, access to clean, reliable data is very important. It's the lifeblood of what they do, essentially. OPEC is also a big provider of data to a lot of secondary sources out there. A lot of guys rely on their long-term forecasts coming out of OPEC. So we're kind of looking at how you can get hold of the data, what's the best way of interpreting it is, and trying to make sure that your biases do not go into the resulting outcomes.
I mean, I think that's interesting because ultimately there is the gathering of the data and the aggregating of the data, and then it's sort of being published and so forth. But then it's what do you do with the data? What decisions are made? And we saw last year OPEC Plus appear to disregard the OPEC data, the OPEC research, and they were cutting supply when OPEC was forecasting a significant increase in demand of over 2 million barrels a day. And toward the end of the year, they revised that down. And here this year, we have the opposite. OPEC is indicating a sort of lesser demand and revising down already. And we've got OPEC Plus increasing supply. So what does that tell you? How should one interpret that? And one year after another, this disconnect between the research and the data being provided by OPEC, and then the OPEC Plus organization sort of doing the opposite from the point of view of output policy.
Yeah, I wouldn't say they disregarded it per se. What I'd say emphasize is that the data provided by the Secretariat is one of the key data sources that ministers rely on when they make their decisions regarding production policy within OPEC and the broader OPEC Plus alliance, but it's not the only one. And if ministers think that their views align more with other providers, then they will go down that direction rather than just following the line that comes out of the OPEC Secretariat's own data projections. Obviously they do rely on them a lot, but it's not the be all and end all for them.
Victor, the inevitable question is in the world today. I mean, there's a lot of questions that the oil markets would like an answer to, but I suppose the biggest question across all markets, and particularly energy, is China's position vis-a-vis the tariff war with the United States. China has so far taken a fairly stoic view. They haven't changed their posture. They haven't really engaged they've obviously retaliated, but they haven't, these claim by the Trump administration that they're talking to the Chinese saying, nobody's talking to us. We're not talking to anybody. What is the sense from the ground in China? Is China in, does this feel like this is a long journey, that this is something that's going to be with us through this whole year? What's your sense about China's posture and where and how long this is going to last?
Well, for average people, there's a strong feeling that the country has to do so because, well, there's no compromising, because we know the United States better than to compromise. And the Chinese government has, well, said repeatedly is not engaging in any talks with the United States. And it's not going to do so unless the United States actually back down to the previous tariff. And is requiring a level field for talks. But before that, we need the United States to do something for the negotiation to be possible. And for different people, it will be different. For factories, they are concerned about the alternative markets, but they also support the government's decision. So that's different. Some express their concerns about finding markets, but most people would say, well, we just support the government's decision, and the government has made it clear that this is going to be a difficult war, yeah, and so it's mobilizing the country, basically the country, to get ready for this one, to be prepared for difficulties over at least quite a long period of time. Yeah. And we do not expect any significant improvement over the short term. Yeah.
What about, Victor, the possibility of more stimulus, significant stimulus into the Chinese economy, something that we've kind of been expecting since COVID? It's sort of come in drips and drabs, but no real massive stimulus. What's the possibility that now that this is the reason they've been waiting for to actually unleash the full possibility of the Chinese government, the full capability of the Chinese government to stimulate the economy?
Yes, well, we are expecting more stimulus in the near term, and particularly more in the second quarter. And these measures include cutting interest rates, cutting the required reserve ratios for banks to increase liquidity and to encourage investment. And another aspect is the support to those factories that have been affected most significantly. I mean, those particularly rely on the United States very much. The government needs to support the workers if they're laid off over the short term of time. And they need to give the factories time to make adjustments to find domestic markets or to find other overseas markets. So they would need more support to make such adjustment because they need time. Yes.
Rahul, as we sort of
Sean.
come to the end of
Sean,
this
just
100, please.
Yeah, I'll just add a few things, right? So I think
Yes, okay.
we just this morning got the PMI data, right? S&P's
Yeah.
PMI data for China. I think the manufacturing contraction, I think, was weaker than expected, or rather, the manufacturing data was weaker than expected, right? 49.7, it came at 49. But the interesting one was the new export orders basically fell off a cliff, right? That was the lowest number since pandemic. So it started happening in terms of the manufacturing side's contraction, which was not expected. The economy grew pretty well in terms of China in the first quarter, but those are the early indicators which we're getting in terms of the weakness stepping in, particularly from the manufacturing side in China. Yeah.
Rahul, I just
Yeah.
wanted to follow up and ask
Yeah.
you, where are we at today, 100 days into Trump, with the sanctions and as it
Yes.
impacts on
Mm.
shipping? Oil
Yeah.
price for Russian crude is below the price cap.
Mm.
Where is sanctions and shipping at this moment? Where's it going?
Interesting, right? So I think if you look at, there has been lot many sanctions, right? It started late last year. This year, every week we are seeing more and more vessels being sanctioned. But what has happened is with the oil price coming down, we're actually seeing vessels which are non-sanctioned now below the price cap getting back in. So as per our data, we are seeing that Russia's dependence on the sanctioned vessel, right, essentially has come down because more European vessels, Greek owners have also come in. So it hasn't had an impact when I say in terms of tightening of the fleet capacity, right? I've always maintained that there's enough fleet capacity available for Russia to export, even Iranian exports, and for China to buy, China and India in that sense. So but we are seeing the freight markets move up, right? The tanker market has been going up. We are seeing across the crude carrying tankers, Aframax, Suezmax, and VLCCs, rates are nearing $50,000-$60,000, right? Primarily because of what we're seeing more volumes coming into the market. There is a bit of congestion on the Chinese side as well as more volumes came about earlier this month as well. So
What
that
about
market is supported.
the scale of the dark fleet? Given
Oh,
that
yes.
sanctions,
Yeah.
or given that the price cap is below,
Mm.
or the price is below the cap, are we seeing a reduction in the amount of ships in the dark fleet?
So I wouldn't call it reduction in the amount of dark fleet. What we are seeing is non-sanctioned vessels are able to carry that now, right? So the sanctioned vessels, as with dark fleet, somewhere in the range of 10 to 12%. The way you look at it depends. It could be much higher to 13 to 15% as well, right? Ships which have carried sanctioned oil or have visited what we call sanctioned ports in that sense. So we're not seeing much reduction in that. What we started seeing is some of those older ships which are part of the dark fleet have started going on to scrap. Right, this is the first time over the last few months some of the big VLCCs, some big Suezmax tankers have started going into the scrap yards. Very early signs of that.
Okay, well, let's go to the survey question, which sort of tackles some of the earlier comments. Brent crude oil fell 20% over the first 100 days of Trump. How will they perform after 200 days, i.e. the second 100 days of Trump? Will oil prices be higher, lower, or not much change? So the first 100 days, they've dropped 20%. What's going to happen over the next 100 days? Go higher, go lower, or not much change from where we are right now? Jamie, of course, OPEC Plus is a big decision to announce in the coming days. June supply plans. We saw the last announcement surprised the market with an acceleration. There was an expectation that maybe they'd continue with 1 month at a time as they had outlined in their very detailed plan. Now they have to make the announcement for June. Your thoughts on where they're likely to go with that decision?
Thanks, Sean. Yeah, as I kind of mentioned earlier, there's discussions with OPEC. It seems as if there's a very strong probability that they will decide to accelerate again, possibly a replay of what happened last month. But I think what's worth emphasizing here is that the actual additional volumes coming onto the market will be significantly below that headline figure, whatever the decision is. A lot of the producers are non-compliant, hence the reason why we have these compliance cuts coming in. And so their ability to actually increase production is limited, even if they don't ultimately adhere to the compliance cuts that they are pledging each month. Technically, if they do adhere to these compliance cuts, production will fall, but nobody really expects the likes of Kazakhstan to make significant inroads in that. Iraq has improved its compliance, but they're coming into the summer season now where they're going to need to start burning more oil in power plants in order to keep the lights on, which, quite frankly, is one of the big issues for the market, is how much oil will be consumed domestically in the Middle East as temperatures rise. As I say, in Iraq, there will likely be new records when it comes to oil burn this year. But one underappreciated issue is probably that Saudi Arabia has started to make some inroads now into reducing its own oil burn with its liquids displacement program, bringing online a lot of renewables and additional gas reserves. The early figures coming out of Saudi Arabia suggest that oil burn dropped by around 200,000 barrels a day year on year in the first couple of months of the year. We've had previous fall storms before, so maybe they won't be able to keep up that momentum, but that's a big game changer if they do indeed manage to keep along that track over the remainder of the year. And frankly, that could impact their supplies to the market more than any near-term OPEC plus easing of cuts.
And Victor, similar thoughts about where, I mean, we talk about the supply side there with Jamie. On the demand side, at these sorts of prices, typically China loves to buy oil. I mean, $60 is a good deal for WTI and a few bucks more for Brent. You'd be putting it in your bathtub if you could, right?
Yeah. Yes, well, that's true. When the price is about $60 is good, a good level for China to increase its storage. And we expect some of the purchase will be for storage too this year. And unless, but crude oil not expected to go much higher this year. I do not expect so. And so we expect the country to increase the storage in the coming months. Yeah.
What about the appetite to continue to import Iranian oil? The U.S. government, the Trump administration, is becoming increasingly belligerent in its enforcement of their maximum pressure on Iran and sanctioning Chinese vessels and Chinese refiners. Is China likely to give up on Iran?
Well, independent refiners have been more cautious as the United States stepped up its sanctions. So, say, for instance, in March, there were more cargoes arriving. But after that, they cut their purchase because of the concerns about new sanctions. And so, compared with March, yes, the volumes had dropped. And we do not expect the volumes to rebound to the levels as high as we saw in March. But some independents will continue to take such cargoes so long as they think it's safe. Yes.
Rahul, last word with you.
Sure.
We saw in the aftermath of the Russian-Ukraine, I mean, not the aftermath, it's still ongoing, sadly, but the shift in energy flows after the start of the Ukraine-Russian war, and then the Israeli Gaza incursion and assault, that we had the disruption in the Red Sea. And so we've had these dislocations in global energy flows, which has resulted over the recent years in ships having to make much longer journeys, and ships having to, doing so, consume more bunker fuel in order to get to their destinations. How is the tariff war affecting the same thing, where we're getting distortions in flows, and so ships having to make longer, different journeys?
Yeah, certainly. So I think the biggest driver of bunkering market is the container ships, right? Those are the massive burners of bunker fuel. Like I said, we did see a bump up on the oil demand, particularly which came from the bunkering market in the first quarter. But like we're seeing now, ships cutting voyages as well as the container market slowing down, that will have a negative impact on the bunkering market in terms of the growth which we are seeing over the last few years, right? I think one thing which we will see, and this is particularly on with respect to China in terms of the trade flows which might change, is the LPG. Right, I think that's the one which we are expecting. So we would expect the US cargoes which are going into China to be diverted, right? We're hearing about India buying some one-off. It has been a sporadic buyer, but Middle Eastern cargoes getting swapped and that going to China, right? That's the market we are tracking more in terms of the shifting flows. US oil, naphtha, and so on, not much going into China right now.
And just a quick follow-up on the Red Sea, Bab el-Mandeb,
Yes.
where obviously the US have been very aggressive in their bombings there into Yemen. What's the flow through the Red Sea like?
Yeah, interesting, right? So I think we did see a flow come back strongly despite what's happening, right? I think if you look at the March numbers, still early in April as well, we've started seeing more tankers which are rerouting, or rather which are going through Suez Canal, right? These are essentially your larger tankers, right? We did see a return of tanker vessels compared to the last year, but overall, marginal pickup compared to the pre-crisis levels. But we've started seeing ships going through, so that's a first sign. Yeah, but our view is it will still take a very long time for the Suez Canal or Red Sea to be fully open.
Okay, well, we'll have to wrap it up there with Brent crude oil. Here's the survey result. Not too much confidence in prices going higher over the next 100 days of Trump 2.0. Lower, getting a third of the vote, and more than half saying not much change. We're going to be stuck here in the mid 60s for the next 100 days. I suppose a lot will depend on what kind of decision OPEC Plus makes. And as Jamie points out, the announcement and then the actual barrels, how many new supply comes into the market or goes out. Halftime talk interview now coming up for in the bunker space, which is obviously what we've been just talking about with Rahul. So please watch out for that. Thank you, Jamie Ingram in the UK, Victor Yang in China, and Rahul in Singapore. Really appreciate your thoughts and insights today. And we look forward to catching up with you all again soon. Thank you very much.
Thanks, Ron.
Bye-bye.
Thanks,
Thank you.
Sean.
Have a nice
Speak
day.
soon.
Cheers, guys.